I want to ask you something, and I want you to answer it honestly. Not the way you wish the answer was, but the way it actually is before you made your last investment decision. Did you write anything down? Not a mental note? Not a vague intention? Not a story you told yourself in your head while looking at a screen? Did you write it down on paper or type it into a document? The actual reason you were buying, the specific price at which the investment represented genuine value? The conditions under which you would sell and what you would do if the price fell 30% before any of those conditions were met? If the answer is no, you are in the company of the vast majority of investors, and the vast majority of investors produce returns that are dramatically below what the market offered them during the same period. Not because they chose bad investments, because they made good investments and then made bad decisions about those investments in the moments when their emotions were loudest and their written reasoning was nowhere to be found today. I want to talk about the single most underused tool in all of investing. It costs nothing. It requires no special knowledge. It takes between 15 and 30 minutes per investment decision, and it has the potential to improve your long-term investment returns more than any stock selection methodology, any market timing system, or any financial education you will ever receive. It is called the investment thesis, and I am going to tell you exactly what it is, exactly what it contains, and exactly why writing it down, rather than thinking it, changes everything about the quality of the decisions that follow the problem with thinking. Instead of writing, let me describe something that every investor who has not yet developed the habit of writing has experienced but may not have named. You find an investment that looks interesting. You think about it for a period of time ranging from a few minutes to a few days. You develop a set of reasons why it is a good investment. You buy it. The price falls and suddenly something remarkable happens. The reasons you developed for buying it begin to feel less compelling. Details that did not seem significant when the price was flat begin to feel more significant. Now that the price is down, you start to wonder whether you missed something, whether the thesis was never as strong as you believed, whether this is one of those situations where the market is telling you something that your analysis did not capture. You read an article about the company that confirms your growing unease, you sell, the price recovers, you watch the recovery happen without your participation, and you tell yourself you will be more disciplined next time. And next time the exact same thing happens, because the problem was never discipline in the abstract. The problem was that you had no written record of what you actually believed when you were calm and rational, and the emotion of a falling price was not yet involved. The human memory is not a reliable archive of investment reasoning. It is a narrative construction that continuously rewrites the past to make the present feel coherent. When you are holding a position that is down, your memory of why you bought it will shift toward emphasizing the risks you should have seen and minimizing the strengths you did see. When you are holding a position that is up, your memory will shift toward emphasizing your analytical brilliance and minimizing the elements of luck and timing that contributed to the outcome. This is not a character flaw. It is a documented feature of human cognition. And writing is the only tool that defeats it. Because writing does not remember selectively. It says exactly what you believed at the moment. You wrote it, regardless of what the price has done since. And when a falling price is generating the anxiety that makes you want to sell, the written thesis is the one voice in the room that is still speaking from the moment of calm, rational analysis that produced the original decision. What the written investment thesis contains. I want to give you the specific components of a written investment thesis, because I have found that people who understand why they should write something down frequently still do not do it, because they are uncertain about what exactly to write. The written thesis is not long. It is not a research report. It is not a document that requires hours to produce. It is a single page that answers 6 specific questions. And when those 6 questions are answered honestly and in writing, you have a document that will govern your behavior through every subsequent price movement the investment produces. The first question is, what does this business actually do and how does it make money? Not at the level of its products, but at the level of its economics. Where does the revenue come from? Who pays it? And why do they pay it? Instead of paying a competitor. This question seems obvious, but the inability to answer it clearly in writing is one of the most reliable signals that you do not understand the investment well enough to own it. If you cannot describe in 2 or 3 sentences how this business generates cash for its owners, you are not investing in a business. You are investing in a story someone told you about a business, and those are very different things. The second question is, what is this business worth? And how did I arrive at that number? Not a range you read in an analyst report, your number derived from your analysis of the financial statements. This requires looking at the earnings, the cash flows, the balance sheet, and making a specific judgment about what a rational owner would pay for this business if it were not publicly traded. It does not need to be precise. Intrinsic value is always an estimate, but it needs to be yours, and it needs to be written down, because the act of writing a specific number forces a level of analytical commitment that thinking about a range never produces. The third question is, why is this business available at a price below what it is worth? This is the question that most investors never ask, and its absence from their thinking is one of the primary reasons they overpay if a business is genuinely worth $100 and the market is selling it for $65. There is a reason the market is not simply confused. There is something about this business right now that is making other investors unwilling to pay full value for it. You need to know what that thing is, and you need to make a judgment about whether that thing is a temporary condition that will resolve or a permanent condition that the market is correctly pricing. A business in a cyclically depressed industry whose underlying competitive position is intact is temporarily mispriced. A business whose core product is being made obsolete by a technological shift is permanently impaired. The difference between those two situations is everything, and the only way to know which one you are dealing with is to think about it carefully and write down your honest conclusion before the price moves further. The fourth question is, what would have to be true for this investment to fail? Not what could theoretically go wrong. What specifically in this business and this industry and this competitive environment is the most credible path to a permanent loss of value? Writing the bear case is the discipline that most investors resist most strongly, because the bear case conflicts with the enthusiasm that typically drives a purchase decision. But the bear case is not pessimism. The bear case is honesty. And an investor who cannot write the bear case for their own investment does not actually understand the investment well enough to own it. The fifth question is, at what price would I sell? Because the thesis has succeeded if you buy a business at $65 because you believe it is worth $100. The investment succeeds when the price approaches full value, but most investors never define what full value looks like in advance, and so when the price rises, they feel the pull of further gains and hold past the point that their original analysis justified. Define the price at which you would consider the investment complete and write it down. This does not mean you must sell at exactly that price. It means you have a rational basis for the decision when the time comes, rather than an emotional one. The sixth question is, at what price or under what circumstances would I sell? Because the thesis has broken the price, falling is not a reason to sell. The price falling while the underlying business remains fundamentally sound is actually an argument for buying more, but there are conditions under which the original thesis breaks, not because the price moved, but because the reality of the business proved different from the analysis. Write down what those conditions are before the price moves. If the earnings for 3 consecutive years come in significantly below the level, I assume the thesis was built on the thesis has broken. If a competitor introduces a product that eliminates the pricing power I identified as the core competitive advantage, the thesis has broken. If management makes a capital allocation decision that reveals the misalignment of incentives, I initially dismissed the thesis has broken. These are thesis-breaking events, not price events, and defining them in advance means that when you sell, it will be because your analysis was wrong, not because your emotions were loud. The second document you must write, and almost nobody does. The written thesis governs individual investment decisions, but there is a second document that governs your behavior across all of your investments in all market conditions. And without it, even the best individual theses will produce inconsistent results. I call it the investment policy statement. It is the document you write when you are calm and rational and the market is not doing anything in particular to your emotions, and it answers the questions that you will be completely unable to answer rationally when the market is falling 30% and your phone is full of notifications telling you that everything is collapsing. The first question the policy statement answers is, what is the purpose of this money and when will I need it? Not all money is the same money you will need in 3 years, should not be in the stock market at all. Money you will not need for 30 years can withstand far more volatility without threatening your actual life. The policy statement defines the time horizon of each pool of capital and uses that time horizon to determine how it should be invested. The second question is, what is my asset allocation and what are the conditions that would change it? What percentage of your investable assets is in equities? What percentage is in fixed income? What percentage is in cash? And what is the rebalancing rule that brings you back to those percentages when market movements distort them? Having written answers to these questions means that when the market falls and equities are suddenly a smaller percentage of your portfolio than you intended, the policy statement tells you to buy equities to rebalance, not the emotion of the moment, which will be telling you to sell. The third question is, what will I do when the market falls 20%? Write it down now before the fall happens. Will you hold? Will you buy more? Will you rebalance? The answer written when you are calm is dramatically more useful than the answer improvised when you are frightened, and the investor who has already answered this question in writing before the fall occurs is the investor who behaves rationally during the fall because they are not making a decision in the moment of panic. They are simply executing a decision they already made when they were capable of making it. Well, the fourth question is, what information will I consume and what will I refuse to consume? This sounds unusual, but it is enormously important. The financial internet in 2026 produces a continuous stream of content, specifically designed to make you feel that you need to act, that something has changed, that the conditions that justified your investments no longer hold. Define in advance what information is relevant to your investment decisions and what is noise that you will not allow into your decision-making process. Earnings reports are relevant. Balance sheet changes are relevant. Fundamental changes to competitive position are relevant. Daily price movements are not relevant. Financial media commentary about what the market might do next week is not relevant. Social media discussion of stocks you own is not relevant. Write the list, consult it when you feel the pull of the noise. The policy statement does not make you a better analyst. It makes you a better decision maker by removing decisions from the moments when you are least capable of making them well. Why writing it changes the quality of the thinking itself. I want to make one more point before the assignment, because it is the point that persuaded me most completely of the value of this practice. Writing does not just record thinking. Writing improves thinking. When you attempt to write a clear answer to the question, what does this business do and how does it make money? You will frequently discover that your answer is much less clear than you believed. The vagueness that felt like sufficient understanding in your head becomes visible on paper as the incomplete analysis. It actually was. This is not a failure. This is the most valuable thing the writing can do for you. It reveals before you have committed capital that your understanding is incomplete. It shows you exactly where the gaps are, and it gives you the choice to either fill those gaps through further research or to conclude that the investment is simply not within your circle of competence and walk away before any money has changed hands. The investor who writes before buying occasionally discovers that an investment they were excited about does not survive the exercise of trying to write a clear and honest thesis for it. That discovery before the purchase is worth more than any return the investment could have generated because it is a free lesson. The lesson after the purchase is also available, but it comes with a tuition fee. Your assignment here is exactly what I want you to do. Take every investment you currently own or are currently considering owning for each one. Write answers to the 6 questions I described. What does this business do and how does it make money? What is it worth and how did I arrive at that number? Why is it available below that value right now? What is the most credible path to permanent loss in this business? At what price would I sell? Because the thesis has succeeded, at what price or under what conditions would I sell? Because the thesis has broken if you cannot write honest answers to all 6 questions. For an investment you currently own, you now have one of 2 options. Do the additional research required to fill the gaps, or reduce or eliminate the position until you can. Neither of these options is comfortable. Both of them are rational, and rationality consistently applied over a long investment. Life produces results that comfort consistently applied never approaches. Then write your investment policy statement, time horizon for each pool of capital, asset allocation and rebalancing rules. Specific written response to a 20% market decline, list of information sources that are relevant, and list of sources that are noise. Keep both documents somewhere. You will actually find them not in a folder you will never open, but somewhere that is part of your regular financial review. Because the value of these documents is not in the writing. It is in the reading of them at exactly the moment when your emotions are generating pressure to make a decision that your calm, rational analysis would never endorse the bottom line. The gap between the returns the market offers and the returns most investors actually receive is not primarily a gap in analytical skill. It is a gap in decision quality during the moments when decisions are hardest to make. Well, writing does not close that gap by making you smarter. It closes that gap by preserving the quality of your thinking from the moments when you were calm and applying it to the moments when you are not. The written thesis says what you believed when you were rational. The investment policy statement says what you decided. When you were calm and together, they give you something that no amount of intelligence or market knowledge can give you in the moment of a market panic. They give you a prior self who already made the decision correctly. Trust that prior self, write it down before you invest another dollar. That is how the intelligent investor thinks. Thank you.